People who trade stock usually have technical analysis and fundamental analysis. More on the technical side of the analysis, we usually have some kind of statistic or data that we can obtain. So today's video, we're going to use those information that we can get from online, convert those data to some numbers which we can compare clearly between different companies in order to see some really visualized results. Last year, one of the hottest industry is called metaverse. So today's video, we're going to pick two main players in this meta universe. The first pick is Facebook to award its effort to change its name from Facebook to Meta. The second pick is NVIDIA, which is the top player in the semiconductor sector. And while Facebook has all the visions and blueprint of metaverse, NVIDIA is the one with all the products and strategies that can actually bring those dreams to reality. So today's video, we're going to pick these two companies to analyze, and we will go through the process step by step so you will get a sense of how this works, and then you can do it yourself. And let's get to it. Yahoo Finance is one of the really great websites that we can use as a beginner to obtain certain public information, to do some company analysis and run some data. And Facebook ticker sign is FB. We click on historical data. So for the time period, we're going to choose 5 years. Frequency is monthly. Then hit apply. Then here's the data, and we can hit the download here. This will be in the CSV format, but we can convert it to Excel if you need it. And next we will download NVIDIA, ticker symbol NVIDIA. And 5 years monthly, we'll do the same. Hit apply, download. We want to keep the variables the same so we can make the right comparison. You can choose different time period and frequency. It's all up to you. But for our purpose of illustration, we're going to use 5 years monthly data. Then last but not least, we need to compare those two companies with the market as well. And in order to do so, we're going to download the SP500, which is not the ETF, but it's the GSPC. So Yahoo Finance got rid of the download button here last year. We don't know why, but it definitely made our life harder. But we can do it another way by selecting all the data, and we will come to Excel, hit paste special text, then here it is. So here's the tricky part. For the data of Facebook and NVIDIA, these are all in the ascending order, but the data we copied was descending order. So what we need to do is simply create another column and turn these to a table. Insert table, hit OK, and choose ascending order. Oops, sorry. This will be descending. So let's get rid of this column. And now you will see the date is ascending order. And convert it back to range. Now you have it. And don't be afraid of all those data because all we need is the adjust close. I'm gonna hit copy and paste. Cool. So this is the market price. And now for Facebook, we also just need this. Close, the adjusted close. I'm gonna put the date here just to make it clear. And this is Facebook to market. And we will do the same with NVDA. Adjusted close. Adjusted close for NVDA. Date. Cool. So now let's do Facebook first. Before we get into more comprehensive regression analysis, we first need to get the return. And in order to get that, simply use today's price minus yesterday's price over yesterday's price. And we will also use the same method to get the market return. And with these two columns of data, we can first use correlation function to get the coefficient of multiple correlations between the company's return and the market return, which in human words means that this number represents whether this company's stock price is positively or negatively correlated to the market index. So if this value is closer to 1, that means it's positively correlated. And since it's 0.92, that means it's highly positively correlated. If it is closer to -1, that means negatively correlated. And if it's closer to 0, that means they're not correlated. And usually for a large company like Facebook, you can easily tell whether this company's stock price is related to the market movement. But sometimes you don't know whether this relationship is really close. So that's why we use this number. Then we will use data analysis tool to run the regression. So we will input the individual stock's return, which is Facebook in this case, in Y range. And for X range, we'll use the market return. So we need to keep our line fit plot available. Hit OK. So now we get the regression. And don't be afraid, there are just a few numbers you actually need from this table. First is beta. So beta represents systematic risk. And higher the beta, higher risk. So before we get into it, we need to know what kind of risk we're bearing when we choose to invest in a company. Before we get into that, we need to know what kind of risk we're bearing when we choose to invest in a company. So there are two kinds of risk, systematic risk and unsystematic risk. Systematic risk is a risk factor that affects a large number of assets and that is non-diversifiable. The example can be the risk of changes in GDP, inflation, or interest rate. So that's kind of like a risk that's built in our economic system, and the minimum level of the risk cannot be diversified. So as much of stocks you may want to hold, you will not be able to eliminate all the risk. For unsystematic risk, that's an asset-specific risk. That's unique to a specific company, such as a CEO replacement, or if there's a huge scandal of Facebook coming out from news. Together, these two risks form the total risk. That would be the standard deviation of the returns, which we will get into that later. So when we run the regression, we find the beta, which is the systematic risk. We need to understand that in order to get this beta, we used both the SP500, the market return, as well as the company that we try to analyze. So it means that the market risk is something built in the beta. So we'll always compare the beta with market risk, which assumes to be 1. So basically, if a beta is lower than 1, the risk of that specific company is lower than the market. The company will give a lower return. And if the company's risk is higher than 1, that means the risk is higher than the market and you should have higher return. So from this website run by Stern, New York University, you would be able to see the industry as well as the industry beta. So for Facebook, it's internet content and information industry. But since we don't have the internet content, we'll use information service, which is 1.01. So that means the industry risk, that's 1.01. And for total risk, we'll use standard deviation, sample, and we will choose the company's return, which will be 15.34%. And we will use this number, compare it with the total risk of NVIDIA later. And next, we move on to the line fit plot. we will add trend line. And if you double click on the trend line, you can display equation on the chart. So this equation right here, this number you can get from here. So basically, this 1.0344, that's the beta, and the 0.0056, and that is the alpha that determines whether the individual security has excess or abnormal return compared to the market. The excess return can be calculated using risk-free rate, which we can access through this website. It's ran by Dartmouth, and it's called Farmer French 3 Factors. It has daily, weekly, and the default one is monthly. And we can also download the CSV file. So after you open it, you will see that the RF, that is the risk-free rate, and this is the date. That's all you need to know. And if you go to closer dates, you will realize that the risk-free rate is getting to 0. And for most part, it's very minimal or even 0. So that's why for our analysis here, we will choose to use 0 as risk-free rate. But if you want a more precise and comprehensive analysis, you can definitely incorporate this. It's simply to add the column risk-free rate, and you will have your new column of data using the market rate minus risk-free rate, which is derived from the CAPM model. That is, the expected return of the asset equals the risk-free rate plus beta times market return minus risk-free rate. So the market return minus risk-free rate, that is the market risk premium, which would be the new column. So basically, you can just copy your risk-free rate from this file, matching the date, obviously, but here I'll just do an example real quick. So what you can do is you can use market return minus the risk-free rate. You will get this new column of data. And for regression, use this column to replace your market return for your X range input. Yeah, so these are just for your information, but you don't have to get into that because first, like we said, most of the risk-free rates of recent years are really close to 0. And also for our purpose of analysis, as a beginner, we can definitely just assume the risk-free rate to be 0. And for your information, if you don't want to use the risk-free rate downloaded from this website, you can definitely use alternative, which is yield on short-term government security. That is another commonly accepted rate as risk-free rate. So next is R squared. This value gives us the percentage of confidence our regression analysis can explain given the data we used, which means higher the value, more confident we are with our regression model. And it changes if we use different time span of data. Usually, it means if we use a more closer to date data with less time interval, it will give us more confidence in our regression model. But disclaimer, this conclusion is drawn from my own past analysis experience. So if someone else using different analysis tool or different data, it might be different. So these are all the numbers that you need from our regression analysis. And now we'll do the same for NVIDIA. So as we finished with the regression analysis for NVIDIA, we will take a quick look at NVIDIA's industry beta, which is semiconductor. That is 1.0. So the industry risk is 1. And also that I forgot to mention, the correlation formula, you can get it right here, which is the R value. So I guess we don't actually need to have the correlation function right here. We can just use it here instead. So I built this table for you guys to make everything looks more visualized. So the market risk is always set as 1. And for Facebook's industry, the beta is 1.01, and for NVIDIA's industry, the semiconductor industry, that is 1. And the regression that we ran, so for Facebook, the 5-year monthly systematic risk, which is the beta, is 1.03. That means it's higher than the market risk, and it's also higher than its own industry risk, which means Facebook has a higher beta than the market benchmark. So it is expected to have a higher return. Same applies for NVIDIA. Both of them should be expected to have higher return than SP 500. And then let's move on to R squared. So R squared, the higher it gets, the more confidence we have in our regression analysis. So 85% is a pretty high number, so we should be pretty confident of our analysis. 63% on the other hand is a little low, but for the R squared number, usually if it's higher than 30 or 40%, it's a pretty good number. And usually we can say that the regression analysis pretty much explains the situation. So we can definitely say that to some extent, we can for sure rely on our regression analysis for NVIDIA. And if it's get even lower, maybe we should choose a different time span, such as 3 years weekly or 1 year daily, stuff like that. And move on to correlation. Correlation coefficient, as we discussed before, that is, the higher it gets to +1, the more it means that the company's stock price moves positively correlated to the market, which means if the market goes up, Facebook and NVIDIA goes up. If the market is heavily impacted by a negative situation and the market drops, Facebook and NVIDIA is highly likely to drop as well. So move on to total risk. So total risk is the systematic risk plus unsystematic risk, which is the company's specific risk. So comparing these two numbers, NVIDIA's total risk is higher than Facebook's total risk. That means if you want to invest in NVIDIA, you need to pay closer attention to this specific company's potential risk, which can be whether the semiconductor they produced has defect, or if NVIDIA stopped its cooperation with Tesla or Apple, things like that. So last but not least, the regression and all the analysis we did in this video are solely based on historical data. And as we all know, historical data gives no guarantee for the future. So all the analysis did in this video is for informational purpose only, and is not for forecasting purpose or investment suggestions. And as usual, this Excel is available to download if you subscribe the email list down below through the link. And please hit the like button if you think this video is helpful, and subscribe to this channel if you wish to receive more videos like this in the future. And welcome back to work and school, and I hope you guys enjoy the first week of 2022. See you next time.